All right, so let's jump right into it. Today we're doing a deep dive into the world of dividend ETFs.
Okay.
And we'll be using an article from the Motley Fool to guide us.
Sounds good.
Now, just in case you aren't familiar with them, the Motley Fool is a financial services company.
Yeah.
And they're all about making investing more accessible. So they've got articles and podcasts,
Right.
a premium service, all sorts of things like that.
Yeah, cool.
And in this article, they're highlighting 3 specific ETFs
Okay.
that they believe could be held forever, which forever is a pretty big claim, wouldn't you say?
Forever in the investing world definitely grabs your attention.
Yeah, it does.
It will be interesting to take a look at these ETFs and see if they actually live up to the hype.
Yeah, I mean, I always used to think dividend investing was mostly for people getting close to retirement.
Yeah.
But the more I learn about it, the more I'm intrigued. Especially when you hear about ETFs like this first one,
Okay.
the Vanguard Dividend Appreciation ETF.
Okay.
Or VG. And the thing that really stood out to me about it
Yeah.
is that it focuses on companies that have a history of increasing their dividends. So it's not just about what it pays out today, but what it could pay out down the road.
Yeah, that's a really important point to consider, especially for those who are thinking long term.
Right.
So think about it this way.
Okay.
If a company have a history of raising their dividends,
Yeah.
they're basically giving you a raise each year.
Oh, okay.
So it shows that the company is strong financially and that they're committed to giving back to their shareholders.
Right.
And that could actually be a good indicator for long-term growth.
That's a good point.
And when you look at how VIG has actually performed, you know, it's had an average annual return of 11.6% over the last 10 years.
Wow, 11.6%. That's impressive.
It is.
Though VIG might not have the highest dividend yield at the moment.
Yeah.
But that potential for growth, especially for someone who's decades away from retirement, that's got to be really attractive.
It is.
Because you get the benefit of those increasing dividends.
Yeah.
And potentially, you know, the stock price could go up as the companies in the ETF grow.
Right. So it's kind of like a double whammy.
Yeah, exactly.
Of potential returns.
Right.
Now let's maybe change gears a little bit.
Okay.
And look at an ETF that has more of a global perspective.
Okay.
The Vanguard International High Dividend Yield ETF.
Okay.
Or VYMI.
VYMI. Got it.
This one invests in companies outside of the U.S.
Interesting.
So right off the bat, I'm interested because of the diversification.
Diversification is always a good thing.
Always.
You spread your risk.
Exactly.
And you might get to tap into some growth in different parts of the world.
Yeah.
And what I think is interesting about VYMI is that some of the companies it holds are names we all know.
Oh, yeah.
Like Toyota, Nestle,
yeah,
Novartis.
Yeah.
So you might not think you'd find these huge global companies in an international dividend ETF.
Yeah, that is interesting.
Right.
But it really shows just how interconnected the whole global market really is.
Yeah, that's true.
You know?
Yeah.
But the Motley Fool thinks that VYMI might be undervalued right now.
Really?
Yeah, it's currently giving a 4.5% yield.
Yeah, okay.
And the underlying stocks are actually trading at lower valuations than their counterparts in the U.S.
4.5% yield, that's a lot higher than VIG.
It is.
But I always thought that higher yields usually meant higher risk.
Yeah.
So is there something else about VYMI that makes it less risky?
Well, that's where those lower valuations that I mentioned come in.
Okay.
The Motley Fool seems to think that the companies in VYMI, that they're actually pretty solid.
Yeah.
And that they have potential for growth.
Right.
But that the stock prices haven't caught up yet. So they see that as a buying opportunity.
Interesting.
Now, of course, it's really important to always do your own research and see if you agree with that assessment.
Right. That's always good advice.
Always.
Okay, so last but not least, we've got the Vanguard Real Estate ETF.
Or VNQ. Okay. And this one invests in REITs.
Yeah.
Real estate investment trusts.
Right.
Now, REITs have had kind of a tough time lately, haven't they?
Yeah, they have.
Yeah.
Those rising interest rates have really put pressure on REITs.
Yeah.
Because a lot of times they use debt to finance their properties.
Right.
And so when interest rates go up, their borrowing costs go up too.
Yeah. So then that would squeeze their profits.
Exactly.
And maybe even affect how much they can pay out in dividends.
Exactly. That's right.
So the article mentioned that VNQ has actually underperformed the S&P 500 by quite a bit over the last 3 years. But they also said that interest rates are expected to come down in the next few years.
Yeah.
So if that happens, wouldn't REITs be in a good position to bounce back?
That's what the Motley Fool seems to be thinking.
Okay.
And VNQ is currently offering a 3.6% yield.
Oh, wow.
So you get paid while you wait for it to potentially recover.
Right. That makes sense.
Yeah.
And when you look at what VNQ actually holds, it's got some big names in there.
Okay.
Like Prologis, American Tower, and Equinix.
Right.
All really well-established companies with a good track record in real estate.
Very cool.
Yeah.
So talking about these specific ETFs has got me thinking about dividend investing overall.
Yeah.
What is it about getting those regular payouts that makes them so appealing?
Yeah.
Is it just about that passive income, especially for people who are getting ready to retire?
Well, passive income is definitely a big draw. Right. Imagine, getting a paycheck from your investments every quarter.
Yeah, that's pretty cool.
Yeah, it can really be a game changer for retirees or anyone who wants that steady stream of income.
Right.
But it's not just for retirees.
Oh.
Younger investors can benefit from dividends too.
Really?
They can reinvest those payouts to buy more shares.
Okay.
And that way they speed up their wealth building with the magic of compounding.
Compounding is a word I hear a lot when people talk about investing.
Right.
But I don't think I really totally understand it.
Okay.
Can you maybe break it down a little bit?
Sure.
Especially when it comes to dividend ETFs?
Yeah. So think about this.
Okay.
You invest, let's say, $100 in a dividend ETF.
Okay.
And it pays you a 5% dividend.
Mm-hmm.
So you get $5.
Right.
Now you take that $5 and you put it right back into that same ETF.
Gotcha.
The next time those dividends come around, you're earning not just on that original $100, but also on that extra $5 that you just put in.
Okay.
And over time, as those dividends get reinvested and keep making more dividends, your investment grows really fast.
Interesting.
It's like a snowball rolling down a hill,
Yeah.
It gets bigger and faster.
I'm starting to see how that can really build up.
Yeah.
But trying to pick the right dividend ETFs can feel pretty overwhelming.
It can.
There's just so many.
Yeah, there are a lot.
So what are some things someone should think about when they're trying to make those decisions?
Well, first of all, you need to know what you're looking for.
Okay.
What are your goals for your money?
Yeah.
How long are you planning on investing?
Right.
5 years, 10 years, 30 years?
Okay.
And how much risk are you comfortable with?
Right.
Once you have a good idea of what you need and how much risk you can handle, you can start to narrow it down.
That makes sense.
Yeah.
It's like finding the ETFs that fit you.
Exactly.
So we talked about diversification with VYMI.
Right.
And its global focus.
Mm-hmm.
But are there other ways to diversify?
Oh, yeah.
When it comes to dividend ETFs?
You can diversify across different sectors.
Okay.
Like technology, healthcare, consumer staples, real estate, like we saw with V&Q.
Okay.
The point is you don't want to put all your eggs in one basket.
Right.
Spreading your investments across different sectors. Yeah. It helps you lower risk, and it can even out your returns over time.
So it's like having a well-balanced portfolio.
Exactly.
You want a little bit of everything.
You want a variety of ingredients.
Right.
Yeah.
Now, you mentioned expense ratios earlier.
Right.
How important are those fees when you're looking at dividend ETFs?
Well, they can make a big difference, especially over time.
Okay.
Because think of it this way.
Okay.
Every dollar that you're paying in fees is a dollar that's not working for you.
Right.
And potentially compounding over time.
Yeah, that's a good point.
So it's usually a good idea to try and find ETFs with low expense ratios.
Right. You want to keep as much of your money as possible.
Exactly.
So besides the yield and the diversification, what are some things that show that a dividend ETF is solid and well managed?
Yeah.
What should we be looking for?
Well, one important thing to look at is the quality of the companies that the ETF is actually investing in.
Okay.
You want to see companies that are doing well financially,
right,
that have a history of making a profit and paying out dividends consistently.
So it's about looking beyond just the yield.
It is.
Yeah.
You got to make sure those payouts are actually sustainable.
Gotcha.
It's like checking the ingredients list before you buy something at the store.
That's a good way to put it.
Yeah.
You want to know what you're getting.
You want to know what's in it.
Exactly.
Yeah.
So what else should we keep in mind when we're looking at these ETFs?
Well, past performance.
Yeah.
It can be helpful to look at.
Right.
But it doesn't guarantee what's going to happen in the future.
Yeah.
The stock market, you never know what's going to happen.
It's so unpredictable.
Trying to time it perfectly is pretty much impossible.
Right.
Yeah.
It's like trying to predict the weather.
Exactly.
You can make an educated guess, but who knows?
Yeah, you never really know.
So as investors, how can we be ready for that unpredictability.
Well, that's where diversification comes in again.
Right.
When you spread your investments across different types of assets, sectors, and different parts of the world, you're basically creating a buffer against those ups and downs in the market.
I see.
It's like having a raincoat and an umbrella.
Yeah.
You're ready for anything.
Right. A weatherproof portfolio.
Exactly.
I like that.
So I think the big takeaway here is to have that well-diversified portfolio. Focus on those good quality holdings.
Right.
Keep an eye on those expense ratios.
Okay.
And remember that investing is a marathon, not a sprint.
Yeah, it's not a get-rich-quick scheme.
It's not.
So speaking of the long term,
right?
Let's go back to that forever investment idea that the Motley Fool talked about.
Yeah.
Is it really realistic to think that you could hold any investment forever?
Right.
And how do we even decide if an ETF really fits with our long-term goals?
Yeah.
I mean, forever is a long time.
Forever is a really long time.
Yeah.
And how can you know what you'll need or what the market will be like decades from now?
Yeah.
You can't.
So forever might be a bit of a stretch.
Yeah.
Yeah.
Realistically, very few investments should be considered true forever holdings.
Okay.
Your goals might change, how much risk you can take might change.
Right.
And the whole global market can change too.
Yeah.
What might seem like a great investment today might not work for you later on.
So maybe instead of saying hold forever, it's more like hold for a really long time.
I like that. Yeah.
Yeah.
It's about realizing that these ETFs could be a core part of your portfolio. But you can't just set it and forget it.
Right.
You still need to look at your investments regularly, make changes when you need to, and make sure they still match your goals and your risk tolerance.
Yeah, because those can change over time.
They can. It's like finding that middle ground between thinking long-term and being able to adjust when things change.
Yeah. Now, what about those 3 ETFs we were looking at?
Yeah.
VYMI and VNQ. Do you think those would work for someone who's taking that more flexible, long-term approach?
Yeah, I think they could definitely be a good fit for a well-rounded portfolio. You know, they each have their own strengths.
Okay.
VIG focuses on dividend growth.
Right.
Which, as we talked about, can really help your returns grow over time.
Right.
VYMI gives you that international diversification. So you're spreading your risk and potentially tapping into growth all over the world.
Yeah.
And VNQ gives you exposure to real estate.
Right.
Which can be a good way to protect yourself against inflation.
Okay.
And also give you that steady stream of income.
They sound like good options.
They do.
But, you know, we've got to remember that there's no such thing as a perfect investment.
That's right.
There's always going to be risk, even with the best portfolio.
Yeah, even with the best portfolio, you can still have ups and downs.
So that's where managing our emotions comes in again.
It does.
When the market takes a dip,
it's
so easy to panic and make a bad decision.
Yeah, it's really easy to let your emotions get the better of you.
Right.
And then you could end up hurting your returns in the long run.
Yeah, like selling off everything and then missing out on when the market comes back.
Exactly.
Right.
That's why it's so important to have that long-term perspective.
Right.
And that plan that we talked about.
Right.
And ways to deal with that volatility in the market.
Right. Stay calm.
Stay calm.
And remember that those short-term changes are just part of investing.
Exactly. It's normal for the market to go up and down.
So it sounds like for successful long-term investing, you need a good plan, but you got to be flexible.
Yep.
You got to diversify.
Absolutely.
You got to pick good investments.
Solid investments,
and manage those emotions.
Yeah. Don't let your emotions make decisions for you.
Right. And we got to stay engaged.
Stay engaged.
With our portfolio.
Yeah, keep an eye on things.
Make changes when we need to.
Exactly.
Yeah.
That's a great summary.
Yeah.
I would just add one more thing to that.
Okay.
Never stop learning. The world of investing is always changing.
Right.
So you got to stay curious, look for new information, and be willing to change your mind about things.
So it's about being a lifelong learner.
It is.
When it comes to money.
Yeah.
Right?
The more you learn, the more confident you'll feel making those investment decisions.
Right. You know, it's really interesting how much psychology is involved in investing.
Yeah.
I mean, we've been talking about strategy and diversification and these specific ETFs.
Right.
But it seems like even if you have the perfect plan, your emotions can still mess things up.
Oh, absolutely.
So this idea of forever investments.
Right.
Do you think that kind of taps into our psychology? Like, are we maybe looking for some sense of security or trying to avoid having to make tough choices later on?
I think that's a really good point.
Yeah.
The idea of a forever investment, it can be really appealing on a psychological level.
Okay.
It suggests stability, simplicity, like you've got it all figured out.
Right.
And in a world that often feels really chaotic and unpredictable, that kind of certainty can be very comforting.
So it's like we're looking for a financial safe haven.
Yeah.
Someplace where we can put our money and not have to think about it for years.
Mm-hmm.
But as we've talked about, that's probably not really realistic.
Yeah, you're right.
Right.
The reality is the world changes, our lives change, our financial needs change.
Right.
What might be perfect for our goals right now might not be the best fit in 10, 20, 30 years.
Okay, so
while a forever investment sounds nice,
yeah,
it's important to be realistic and flexible.
So if we're not going to try to find this perfect forever investment,
right,
what's a better way to build a long-term portfolio?
Well, I think it goes back to what we've been discussing.
Yeah.
Having a good plan, diversifying, choosing good quality investments,
right,
and probably most importantly, staying involved with your portfolio over time.
Involved. That's a key word, isn't it?
It is.
It's not about just setting it and forgetting it.
Right.
You've got to check in, reassess, and make changes when you need to.
Exactly.
Yeah.
Your portfolio should change as your life changes. And that means staying informed about what's happening in the market and the economy.
Okay.
And how all of that might affect your investments.
So it's about finding that balance.
Yeah.
Between having a long-term vision and being ready to adapt when things change.
Right.
And not being afraid to make those changes.
Exactly.
When your goals or circumstances shift.
Yeah.
Okay, so you've got to have a plan, but not be married to it.
Right.
Be disciplined.
Yeah.
But not too rigid.
Yeah.
Find that balance between thinking long-term and being able to adapt.
So what about those 3 ETFs that we talked about?
VIG, VYMI, and VNQ. Do you think those would work for someone who's taking this more flexible long-term approach?
Yeah, I think they could definitely be a part of a well-rounded portfolio.
Okay.
Each of them has its own advantages.
Yeah.
You know, VIG focuses on dividend growth, which can really help your returns grow over time.
Right, through that power of compounding.
Exactly.
EYMI offers international diversification.
Right.
So you're spreading out your risk, and you might get to benefit from growth around the world.
Yeah.
And V&Q gives you exposure to real estate.
Right.
Which could be a good hedge against inflation.
Yeah.
And it could provide a consistent stream of income.
Right.
They all sound like good building blocks.
Yeah.
But we've got to remember that there's no guarantee with any investment.
That's right.
There's always going to be some risk.
Always.
And even the most carefully planned portfolio can go up and down.
Oh, absolutely.
So this is where managing your emotions comes in again.
It does.
When the market drops, it's easy to get scared and make a rash decision.
It's really easy to let your emotions take over.
Right. And that could really hurt your returns in the long run.
It could.
Like selling everything when the market's down.
Yeah.
And then missing out on the gains when it comes back up.
Exactly.
So it's important to have that long-term perspective.
You're right.
Stick to your plan and have ways to deal with those ups and downs in the market.
It's all about staying calm.
Yeah.
Staying focused.
Right.
And remembering that those short-term changes are normal.
Okay, so to wrap it all up.
Yeah.
It sounds like the keys to success for long-term investing are have a clear plan, but be flexible and adapt.
Right.
Diversify across different types of assets in different parts of the world.
Absolutely.
Pick good quality investments.
Yeah.
Manage your emotions.
Yeah, don't let fear or greed make your decisions.
Right, and stay engaged with your portfolio over time.
Stay engaged, yeah.
That's a great summary.
Thanks.
And I'll add one more thing to that. Never stop learning.
Oh, that's so important.
The world of investing is always changing.
It is.
So you got to stay curious.
Yeah.
Keep looking for new information. And don't be afraid to change your mind about things.
Be open to new ideas.
So it's about being a lifelong learner when it comes to your finances.
Exactly.
The more you learn,
the
more confident you'll feel about making those investment decisions.
You'll feel more empowered, too.
Right.
Yeah.
Well, this has been a really insightful deep dive. We covered a lot.
We have.
From specific ETFs to the psychology of investing.
Yeah.
What final words of wisdom would you offer our listeners?
Well, I would say this.
Right.
Investing is a journey, not a destination.
Yeah.
It's about making smart choices.
Yeah.
Being patient and staying focused on your long-term goals.
Yeah.
And remember, you don't have to do it alone.
Right.
Get advice from people you trust. Learn from experienced investors. And most importantly, believe in yourself you can create a secure and successful financial future.
That's great advice.
Thanks.
Well, thank you so much for sharing your expertise with us today.
My pleasure.
It's been a really valuable conversation.
I agree.
And to our listeners, we hope you've learned something.
Yeah.
And that you're feeling inspired to take control of your financial well-being.
Absolutely.
Until next time, keep learning and keep investing.
Great advice.